Have you wondered what financial advisors actually think about finances? This is your sneak peek at the conversations within Financial Design Studio. Michelle Smollenberger, the CEO here, will be your host as you go behind the designs.
All right, welcome back to the podcast. It is definitely fall. The leaves are starting to turn, so we're talking, we've all got our pumpkin spice latte or beverage, water probably, in hand. But I have Rob from the team here with us. Rob, our investment analyst. And then we're also welcoming today Tom Cramer, who is with us. And Tom, we have talked to in the past, so this is like a fun welcome back.
Thank you.
To joining us. Tom Cramer is a mortgage loan officer with Wintrust Mortgage. This is really kind of a, since COVID, because we talked, it's been 2 or 3 years.
On your deck. We had to keep 10 feet apart the last time.
Exactly. Yes. And that's it's like, I'm just thinking back, so much has changed, even though during that time, so much had changed too, to be able to get loans done, things like that. So this is really, a catch up from then, what's changed since then. But also, we're going to talk about a lot of things that, between the three of us, I think when we think back, what's changed like since 2007, 2008, even before then, is I think it's really helpful for people to just realize that so much changes with mortgages, lending, whether that's homes, whatever that is. And, at different points in those, you could probably, as a listener, you could probably think, well, I was a first time home buyer at that point, and now maybe I'm a second home, purchaser, or maybe I'm doing construction loan or something. You're a different type of borrower at different points in your life. So I think that's what's interesting, and all of the things change depending on what type of loan it is that you're wanting to get. So that's a preview. We're going to jump into all of this. But before we do, Tom, why don't you just tell us a little bit about yourself? We know that you're an avid cycler, so we are really curious to hear where your favorite bike path or trail or trip is that you take. Tell us a little bit about that.
So I am a member of the Barrington Bicycle Club, and so we get together pretty much 5 days a week almost,
Wow.
So Saturdays and Sundays are the longer rides, and we'll take off from Barrington High School and we'll go either to Lake Michigan and have coffee in Highland Park, or we'll go up and around Lake Geneva is one of my favorite rides, and or down to Huntley and out to Genoa. And
Wow.
So these are not 5 mile bike rides. You're going round trip.
We're doing anywhere from a short ride would be 35 miles to 100 miles. Yeah.
Wow.
Nice.
That's what I was just going to say. We're not going to the park and riding our bike. I mean, we are going on a journey.
Yeah. So I think it's a little safer to ride with a group because you're seen by cars a little better.
Yeah. Yeah. Well, that's great. And how long have you been doing that?
Oh boy. Probably over 15 years, I would think. Helmet is very important. Always wear a helmet.
That's good.
I've gone through 3 of them.
Yeah.
Oh, boy, really?
Yeah.
Okay.
Yeah.
Wow.
Yeah.
No, you're going to learn everything today. So everything from mortgages to biking.
So it's a good stress relief for me.
Yeah.
You get out there, you cycle, and I think through customer, problems or just solving some loan issues I might have. You're just out there and frees up your mind to think more clearly.
Yeah.
Oh, that's great. That's so interesting. I love that. Okay, well, and your bike rides will get really pretty. I mean, now that it's fall.
Yeah, that's when I like doing the Lake Geneva ride because of the changing leaves. Yeah.
Aw, that's great. Well, thanks for sharing that.
Sure.
So tell us a little bit, how did you get into the mortgage industry? How did you, what drew you into it?
So I got my degree in architecture, and I was working as a senior draftsman, and I had our second child, and I just was not making enough money, really, honestly. And my father was in the mortgage business for a long time, so he said, why don't you join me in the mortgage business? And so I took my love of math and people, and I'm like, I could do this. And so he helped me learn the business and also gave me a step up with having his database of people, because it's hard just to jump into the business, and because you're 100% commission, so it's a lot of networking.
Yeah,
So.
we were kind of joking here. Yeah, you could draw up the house plans and then finance the mortgage with your architecture and.
Yeah, so I used to design them, and now I finance them.
Yeah. Oh, that's great.
Yeah, but not, doing construction loans, you're looking at drawings. And so I know what I'm looking at.
That's great. So, yeah. Well, that makes sense.
Yeah.
That's
You're
actually
like, you don't want your front door there. You got to move it over a foot or so. Yeah.
That's actually really interesting. Like a unique perspective to have
right.
as the mortgage officer. Yeah.
Yeah.
That must be a huge advantage, though. I mean, being in the mortgage business that long. I mean, because kind of like realtors. I mean, when markets are hot, it's like everybody and their mom wants to be a mortgage person or realtor and all that, and people come and go. So, I mean, being in the business that long, I'm sure it gives you a really huge leg up on being able to help people and really guide them through, maybe some more challenging loan applications.
Right. But, I've seen my ups and downs over the years. So, you have the person that would just answer the phone and you want a 30-year fix. That's why I'm going to give you a 30-year fix, but not asking all the right questions and, having the right down payment that works for you or having a down payment assistance program. I mean, I've had first-time homebuyers with very little money, and I could help them get into a house with as little as 1% of the purchase price, and the rest of the money could come from a down payment assistance program like IDA, or we also have our own grants at Wintrust that comes out every day. So I've had 2 grants on top of a first mortgage. So
oh, cool.
That's great.
Yeah.
I think that's the thing, kind of one of the big takeaways from today is people don't realize it's not just that you find the house that you want. How am I going to pay for this?
Right.
That is, the ultimate goal, but there's a lot of opportunities and programs available, through government assistance and things that you can qualify for that we wouldn't even know exist. And these change all the time.
Yeah.
So.
Yeah. Our parents always, had the belief of you need 20% down before you could buy a house. And that's really still people out there thinking they need 20% down. You look
it's very pervasive. I mean, we hear that all the time. I think that way as well. Even just getting mortgages in the past, it's like, got to have that 20, got to have that 20 all the time.
Yeah. And then you look how high rent is getting, and so I compare how much you pay in rent and how much a mortgage would be with the tax benefits of writing off the, real estate taxes. And sometimes it's cheaper to own.
Talk us through a little bit. Yeah. So the current environment, what we see and what a lot of people see there's high rates. We went from really low rates to 3%. Just talk us through what you're seeing from your front row seat, really, into mortgages. What is that like?
Yeah. So we're probably at a 20-year high with interest rates right now. But when you look at historically, I think the average is 7%, and so we're sitting around 7.5, 7.75. And so we're really not that high. But so people really have to just get used to the environment. We were just at an incredibly low environment a couple of years ago, and people got spoiled with their 2.5, 3%.
Yeah.
But
has that affected the number of loans, mortgages that you're seeing?
Yes. So the mortgage business is really down right now because of, in the past, we've always had refinances. Now we don't have refinances because the rates are high. We have a very low inventory of homes because you have a person sitting at 2.5%. They don't want to leave that house because they're at 2.5%. So they're sitting on these bigger houses where they really would like to downsize to a smaller house and let that growing family move up to the bigger house. Well, now the move-up buyers can't move up because the downsizers aren't downsizing. So then when you do have someone that puts their house on the market, you have a bidding war. And then the houses are going for more than what the list price is, which is increasing the value of homes. So even though you have higher rates, the values of homes are either going up or staying the same. Now, there are some markets that are coming down, like the secondary home markets like Florida or Arizona.
It's interesting how things shift. So when demand is down, it's interesting because do you see then more programs become available, whether it's through the financial institutions or government, to kind of help get people back into it?
Yeah, I mean, it's the down payment assistance programs. They're no longer just for first-time homebuyers. In the past, you had to be a first-time homebuyer, but it's now income-driven. And so basically, if you're making over $132,000 a year, you're not going to qualify for those programs. But if you're making less than $60,000, then you're going to be qualified for more of the assistance.
Okay.
So,
okay.
Yeah.
That's helpful. That's helpful, even just kind of knowing that range.
Yeah, because I'll have first-time home buyers that come to me and they don't have a down payment though, but they make more than $132,000. So that's when we look at doing maybe a 401k loan or a family member giving a gift. So in the past, you used to have at least 5% of your own money, but that's not the case anymore.
Yeah. And is that $132,000? Is that jointly, or is that just one per borrower?
That's a great question. So that if that's a household,
Okay.
so if you have two borrowers, that their combined income can't be higher than that. But if you drop the one borrower and the one will qualify on themselves, you could use that.
Yeah. So I mean, we're just now starting to get into the meat of this, but these are the little things that, just like with anything in your finances, like someone who knows what they're doing, these are the great conversations you want to have. And I know, Tom, this is one thing that you really want people to walk away with is to come talk to you before they find that house and when they're starting to look, because these are the things that you wouldn't know and you don't think of. You just think, well, this is all my income.
Right.
This is all our income, but the way you structure your loan really matters.
Yeah, because I have two borrowers, husband and wife. They want to buy this house together. The husband has kind of mediocre credit, but the wife has great credit. Okay. And there's loan level price adjustments for credit scores. So if the husband is dragging the rate, making the rate higher because of the lower credit score, I look at, will the wife just qualify on her own? And then we'll put the husband on title, but just not on the mortgage.
Interesting.
To give them a better interest rate.
In that case, can they still use the combined income for underwriting, or does it just focus on whoever has the better score?
So the way it works is we do a tri-merge of credit, and it's the median score of the lowest borrower.
Okay, that makes sense.
Yeah, no, that's interesting. And that's another unique thing too. It's like you want to be sure they're on the title. So they can just be named on it, but their income and things are everything else is kind of excluded.
Right. Say they don't quite qualify because the husband just went self-employed. And with self-employment, you have to have a 2-year history of that. And so they might have another family member that doesn't have any debt that's willing to co-sign. And so I could add that person as a non-occupying co-signer. Okay. And then when they get back where they could both qualify, then we could refinance to get the other one off. So.
Okay. There's just so many options. And what I think is interesting is, you're kind of talking about different situations. So I just think of someone coming to you and saying, here's what we're trying to accomplish.
Right.
And what are the options that we have? And so, and just kind of saying, and what's interesting, it's not just here's what we're trying to accomplish. Here's my information. Here's my spouse's information. Once you see all of that, because there's documents people have to get to you.
Right.
But then it's really helpful. So then you can really say, okay, here's, currently what the best path is.
Right. Because if you're calling saying, "Oh, I love this house. What's your 30-year fixed rate?" I hate those calls because I'm not an order taker. I'm a planner, a mortgage planner, and so you don't want to just go to someone that's going to give you a rate, and it might be a low rate, but then you find out that you're paying a lot of points, cost to get that rate. And, But let's look at it in the long term. My favorite question is, what's your ideal payment? Because their payment and their house price could be totally, not achievable. They don't understand,
What is it that you need to see? So someone comes to you. What is it that you need to see from them? I mean, do they actually need to start the loan application process, or can they just bring documents like pay stubs, tax returns?
Yeah, so that's the difference between a pre-qualification and a pre-approval, basically. So, or what we call a premier buyer letter. I ideally like to have someone complete my application online, and then it gives me the authorization to pull credit, and the credit's the most important, almost the credit, then the income, and then assets. So you need to see the full picture before you give someone an idea how much they could afford, because they could have a lot of student debt out there that you're not paying anything on because it's, there's no payments until you Sorry.
They're not.
Have to go.
No, you're
Yeah,
right.
no,
There's no
that's
payments
good.
that are required
Yeah.
right
Yeah.
now. So that's one of the things. I mean, all of this ties together.
Yeah.
That's why we're having these conversations,
Yeah.
because we see the student loan payments, and Rob, you can speak to this really well. People haven't had to make these payments for a while,
Right.
but they're going to start soon, or
Yeah.
They're starting
already.
in October. Yeah, right
So-
now.
So
Yeah.
we have to use either a 0.5% of the balance or 1%. It depends on which investor we're going to. So
Okay.
Fannie Mae and Freddie Mac have different guidelines on that. So
Okay.
that's another good reason why you want to choose someone like me that has the option of going to either Fannie Mae or Freddie Mac. Some banks, if you go directly to a bank, that they only use one, so they only have that one option.
One question. So you mentioned, like it's to give you all the information. Pulling someone's credit is really valuable to see. So let's say someone says, I'm starting the home buying process, or I'm starting in this process, and you're going to pull their credit. Are you going to have to pull it again? Like, how many times? What time frame should people be coming to you before a purchase?
That's a great
Talk us
question.
through that.
Yeah, so I only pull it once, and then if they find a house within 90 days, I don't have to pull it again.
Okay, yeah.
If they end up going past that time period and it expires, I don't pull it again until they actually get a contract. And I just say, is your credit still the same? Have you taken on any more debt, or have you not paid something? And so
So this might be a really good point. Anything you want to tell people who you pull their credit and you're like, don't do this because it could affect your credit score.
Yeah, so they can get their credit pulled by multiple lenders within a 15-day period, and there won't be a change to the credit score.
Okay.
Oh, that's good to know.
Yeah. But if they're looking at a car and they're looking at furniture and they're looking at a mortgage and they're having 3 different people pull their credit, it's going to affect your credit score.
Yeah.
But it's good to pull your credit at least once a year yourself. You can go to myfreecreditreport.com or something like that.
Yeah.
And you want to make sure that there's no doctors, liens, or judgments against you. And I see medical collections for $50 and taking someone from an 800 credit score down to a 700, just over $50. So that's the stuff I want to find. And or you might have revolving credit balances over 50% of the limits, and so that's will affect your credit score.
Yeah.
And so I have a what if simulator, and I could play with balances on the credit report and also remove collections, and it shows me what the possible credit score could go up to.
Yeah.
Because ideally we want to get everyone above 780 so they get the very best interest rate.
Okay.
So.
And has that changed even like that? You mentioned
Yeah,
780. Is that
it was 740.
Okay.
And then this year it went up to 780.
Okay.
Oh, just this year it went up to 780.
yeah.
Okay. Is that just in response to higher interest rates, or is there something else at play there?
Yeah, that it's all about risk, I guess. It's Fannie Mae and Freddie Mac, whatever they say. It's because they came out with all the differences in loan level pricing this year, that especially on second homes too. So second home interest rates used to be the same as first homes, but people pay their bills. They pay their home mortgage first, and then they'll pay their second homes, and then they'll pay their investment homes in that order. So the risk becomes higher, on the second homes and the investment homes, because they're seeing more defaults on those than they would on a primary residence. So they just build in the risk-based pricing.
Right. Okay.
And that's why that rate's higher on the second home, and then any after that.
And then obviously if your credit score is lower, you have a higher risk in defaulting on the loan.
We probably don't see this dynamic as much today as we did 2 or 3 years ago, but people keeping their homes and renting them out, kind of becoming their own landlords. How is that kind of factored in? If somebody says, well, I don't want to sell my house, but we're going to move to like Arizona and buy something. How does renting their old house impact their ability to get a mortgage for Arizona, for example?
That's a great question. So especially if you want to start investing in real estate, the best thing to do is to buy it as a primary residence and then live in it for a year, because after a year, then you're allowed to rent it out.
Okay.
So buy it with minimum down, So you keep your cash for the future purchases. And then when I qualify you for that next purchase, I could take 75% of the rent to offset the cost.
Oh, okay. That's good.
So if you've been renting your house already, though, we have to take a 2-year average of the income shown on your tax return.
Okay.
Yeah.
Oh, that's good to know.
Are you seeing a lot of people doing that? I guess they have these great low rates on first homes, but they're wanting to move. Are you seeing a lot of that, or not necessarily?
With the values up right now, no, I don't see as much as that. I've seen them selling their houses, but or even selling their investment properties. You know, if you're young and you're buying a condo, you got to be really aware of, will the association allow me to rent in the future? Because I've had some clients that weren't allowed to rent, and then the downturn happened in 2008 where the values came down. So now they owed more than their house is worth, and they needed to move out because the family's growing. So they had to either do bring money to the table or do a short sale.
Yeah. So walk us through, I think that's a good point. When we say like so much changes over the course of the years, walk us through just kind of like a timeline of what people might remember. I know we had like the subprime mortgage lending where, like, just like you described, values were a lot lower than what they owed.
Right.
And since then, kind of walk us through like a timeline of what you've seen.
Yeah, so back in prior to 2008, we had no income or very little income documentation requirements, and it was mainly based on credit scores. And then you had the what they call pick-a-pay or pay option arms, where you were able to choose from 3 different payment options, and one of the payment options was actually less than the interest on the loan. So your principal was growing. It was getting higher. So
we call that negative amortization.
Yes,
right?
negative amortization loans.
Not what you
So
want.
that's what helped crash the market, because the market, that value started coming down, and the homeowners' balances were going up. So all of a sudden they started owing more than the house is worth, and they walked away from the mortgage. Yeah.
Are those option arms? Those are completely gone.
Yes, they're
can you
gone.
not negatively amortize?
No.
What's funny about that is if you look at student loans, the way the federal government sets up the income-driven payments, that's exactly what they do. They negatively amortize the student loans so the balance goes up. So it's kind of crazy that they outlaw it for mortgages, because yes, that is a bad thing.
Right.
But when it comes to student loans, it's like, it's not a problem.
Right. That could be the next problem.
Yeah.
Really.
Well, it probably will.
That
be.
and credit cards. Yeah.
Well, that's the thing. It's like, in all of these, that's why it's interesting as you're talking. I'm like, did we not learn from, because you were even kind of mentioning in some of our conversation is, how some of those like lower income, no documents, some of those are like starting to come back. Didn't we learn from that the first time?
Right.
Yeah.
So so 2008 happened, the market crashed, the values came down, then mortgage underwriting got more stricter then. Okay, now we got to make sure these people qualify for loans. So so nowadays we are seeing a relaxation of the requirements. I mean, we run all of our loans through Fannie Mae or Freddie Mac's underwriting engines, and they'll tell us what they're looking for. So I could have a W-2 borrower that it only requires a pay stub. So I don't need to get their tax returns or get their W-2s, but I always still want to see the tax return, at least the first page, just so I know that they don't have some, YouTube channel that's or some business that's losing money. I have to count the negatively against them. So
No, I think that's actually a really good segue into like self-employed borrowers. Are there things you're seeing from them that are uncommon, or what is common that you need from them when they're trying to get a loan?
Right. So you need a 2-year history of that self-employment. So I need 2 years of tax returns. And so if you're a W-2 borrower, and a doctor is a good example. So you're a doctor, you work for a practice, and now all of a sudden the practice says, well, we want you to buy into the practice, and then they make you a 1099. So now you're an owner of this. Now all of a sudden you don't qualify for a mortgage for 2 years. You have to wait until you get, and people don't realize that. And and I've had a client in the past actually sell their house and get in a contract on another house and then call me saying, okay, we're ready for that mortgage. And I'm like, but you just became 1099. I can't use your income.
Yeah.
And in this case, she was lucky she was able to go back to her company and get that switched where she became hired again as for a company.
But that's pretty important for anyone considering opening a business because I mean, it's not only 2 years that you need it, but if you're starting something, you're probably not going to make a ton of money in years 1 and 2 anyway.
Right,
so, just being very thoughtful about your housing decision, maybe before you make the leap into, I'm going to be a business owner.
Call your mortgage professional before you sell your house because you don't want to be homeless.
Exactly. Yeah.
But if you're in business for 5 years or more, most of the time you get away with just 1 year tax return.
Okay.
Yeah, but you have to prove that you've been in the business 5 years.
And do you, so when you look at it, suppose, and because my wife and I are probably going to build a house next year and we're starting to think about this, but when you look at somebody who owns a business, are you looking at not only their W-2, but also their share of the profits? Is that kind of you're looking at that so it isn't solely dependent on W-2 or what the profits are? It's kind of looked at as a whole, would you say?
Yeah, we look at it as a whole. And so you could have 20% ownership in a company. You're going to get a K-1. We're going to take that income from the K-1. Now, that income could be a negative income where we have to actually hit you with that negative loss. But I'll always see on the tax returns, the other partnerships, and they never give me those returns. But I ask for the K-1s on them because if they're 25% or more ownership, I need to have the business returns too.
Yeah. It's interesting. It's not just, is it positive? Is it going to be 0 or positive? But if there's a loss, that's going to
now some of that loss could be depreciation, and then you could add that depreciation back. So
I mean, there are a lot of people I think today that own businesses or are starting them. So I think that's really helpful to know what it is that they need to be careful of. All right. Some that we've seen just recently, we've actually several clients, just new builds, so construction loans. What do you see there? Anything that they should be watching out for or aware of?
Yeah, buy the lot first because we need 10% into the deal, and then we build in a 5% contingency. So we really need 15% of the total price, the build plus the lot. A lot of times the lot is that 10%. So it's easiest to purchase the lot, even though we can do the construction and purchase all at the same time. But a lot of times the sellers don't have the time for you to wait, get your drawings and contractor pricing all done.
So that's helpful because it's such a unique thing. But I just see a lot of people actually, nearing retirement that are, because I think the areas they're wanting to move to are really popular areas. And so some of the things, they're just not finding what they want. And so I feel like people are moving to these places and they're just finding they have to build what they want because it's not available. So I feel like I'm really kind of seeing this more with kind of these near retirees or that group.
Yeah, it's a good time for a builder right now because they're the ones that have to provide us inventory. But I would suggest if someone's got their house paid off, get a home equity line of credit while you're still there living there as a primary residence. And then you could use that line of credit to either use it for the construction or for the down payment for the construction. And so keep living in your home while the construction is happening.
So then you sell that primary home
and then you pay off the loan or pay down the loan.
You're only paying interest on what you actually use, right?
Exactly, yes.
And then, builds can take, a year. Interest rates will fluctuate during that time. So if you're doing like a construction loan that's going to turn into a permanent loan, at what point are you kind of underwriting to whatever interest rate is? Are you waiting until they lock, like towards the end of the build? Or are you doing some of that up front?
So the great thing about our program is we are underwriting upfront before construction happens, and it is a permanent loan. It's a fixed term arm, So, for instance, my biggest or most popular one is probably the 7-year ARM. So it's fixed for 7 years, but during construction, you're paying interest only, like you said, on that fixed rate. That's I'm guessing it's at 7.5 right now.
Yeah.
And so you're paying 7.5. But the nice thing about it is the construction period is either a year or a year and a half, depending on the project size. And that fixed 7 doesn't start until after the loan converts. So really, it's a 8 or 8.5 year.
One of the questions I think we had talked about before is I feel like at different periods of time, like your 30-year traditional mortgage has really kind of been, that's what people try to get because then you have the longest time to pay it off. But then your 15-year, is even more ideal because you get a lower rate.
Right.
But then, when those rates are high, people typically think of ARMs.
Right.
And it's kind of like, I can get maybe a lower, but it might adjust sooner. Are you seeing that those are better or which one right now?
We used to be able to fall back on ARMs all the time. I love 5-year ARMs, only because I have repeat customers every 5 years.
We'll see you soon.
But it worked out really good for the people that were knowing they're going to make more money in the future, or when interest rates were high, they had an option to go in lower. But right now, with the short-term rates actually so high, the yield curve is inverted. So our ARM rates are higher than the fixed term. So I feel kind of bad, like not giving as much options as I used to give. I'm like, well, we have the 30-year, the 20-year, or the 15-year fixed, really.
Yeah.
And the difference between a 15-year and a 30-year is not that much at all anymore. So
what is the difference?
So it's only like 0.5% at the
Wow.
most. So probably better off just going on a 30-year fix and paying extra towards principal.
Yeah.
We like to call it you're renting the rate. So don't worry about, you're not going to keep that loan for 30 years. We're going to refinance you as soon as the rates get lower and it makes sense to.
This would be good to ask you. This has been a good question, like with the other professionals that we've talked with too, kind of like in your own business that you personally experience, what rates, like over your first time, like maybe your first time rate that you had on a mortgage personally, or have you seen these and do you feel like we're kind of near a high or?
Yeah, so my first rate back in 91 when I purchased my house was 8.5.
Okay.
I think. And it was an IDA program back then. So, and then in the later 90s, we saw the rates drop. I think I refinanced 6 3/4 or something. And that was like awesome, And then when I got into business in 78, the rates were back around 8%.
Okay.
And then in the 2000s started dropping again. And then, then 2001 happened and we saw rates come down because of, the tragedy in September 11th.
Yeah.
And then we saw the rates come back down after the 2008 debacle. And then then the pandemic hit, and then just rates just got just unbelievably low.
Yeah.
And that's what kind of is hurting us now because the rates were so low. Everyone refinanced there, and now they don't want to give up those rates. So.
Yeah. No, that's a really good point because I think it depending on when you purchased a home, your perspective is, my first mortgage, if your first mortgage was in the 8%, seeing the 2s and 3s and then now back to 7 isn't a big deal. But if your first home purchases were in the 2 and 3%, you're thinking, wait, this is so much higher. I want to go, but these might not come back.
The biggest mistake someone can make is I'm going to wait till next year when rates are lower.
Yeah.
Well, price of homes could be higher.
Yeah.
And so, you just have to get a payment within your budget, of course, but knowing that you're not going to have that loan forever. So, but I always used to be able to look back at ARM rates as an option, and they were always lower except for this year.
Yeah.
So you talk about affordability a little bit right there, and I'm a math guy, and I love kind of doing the numbers. One thing we often hear about with mortgages is the debt to income ratio. And, there's any number of calculators on the internet that people can punch numbers in. But could you just talk about, how does that work? What does it look at? And what are some of the more common limits in terms of how big of a mortgage you can get?
So generally, you want to be your total debts into your income is generally 43%. But we could go as high as 50% with someone with really good credit. But I personally don't feel really comfortable about doing that if I know it's a true 50, because I'm like, going out to eat is expensive now. You definitely want to go out to eat.
Yeah.
But if I have someone that I know they're making other income, or there's someone else in the house that maybe not on the loan, then it's fine to go to 50. But I make sure that they know their budgeting. Your question makes me think about the difference with the interest rates. So I looked this up the other day. So in 2019 versus today, if someone qualified for a $2,000 payment, the difference between the rates there and today equals $95,000 in purchasing power.
Holy cow! So just breaking it down. So debt, that's just your monthly contractual debts that you have to make. So like car loans or student loans, things like that.
Right.
And then the income, is that gross income, or is that like take home pay, or how do you look at that?
It's gross before taxes.
Okay.
Yep,
Okay.
yep. And so there's a front end and a back end, it's called. So the front end ratio is just your housing payment. And so it's your principal and interest, taxes, insurance, and if you have association dues. Okay. So that into your income. There is then you add what you see on the credit report, what the minimum payments are. And so there might be times where I have to say, well, this credit card's got to be paid off, or maybe the car's got to be paid off. Now, if the car loan has less than 10 payments left, a lot of times we could exclude that from the right ratio.
Yeah. Okay. A lot of our clients will use credit cards but pay them off every month. Yeah. So, I mean, how does that, from a timing standpoint, how does that work?
Yeah, if you know you're going to buy something, then just pay it off sooner. But the creditors report between the 1st and the 15th of every month. Okay. And so you want to know that, okay, wait to pull my credit until on the 16th.
Oh, that's good.
Or like I said, with my what if simulator, I could show them what their credit score would be, or what they qualify for, and we could have them make that payment and then reach out to the credit company and do a update to the credit report. Some banks won't allow that, but we can.
That's what I think is so interesting, is when people realize how connected everything is. So when we're talking about mortgages, but even just like credit cards right now. So if you think about when rates are high, I mean, all of these places, they're businesses and they're trying to attract customers to use their product services. So just like a credit card, for example, if you had a balance, let's say you have a card with a balance of $5,000 or $15,000 and you can't pay it off. If you have like a card and you do some of these 0%, for a year or two, so the minimum payment is really low. Like, are those some things with those credit cards that people could use because you're really looking at the minimum payment, or not necessarily?
Yeah, they could spread it out if it makes their payment lower. Yeah, sure.
So it's not necessarily the overall balance. Like, you could be well below that 50% of the outstanding balance, but you just know I can't pay this off before, but if I could get my payment down, that's kind of like another thing with your credit you could kind of do. Okay.
Yeah, and that has a lot to do with your down payment then too, because you might want to put less money down to pay off more debt.
Yeah. I just think that's interesting. Like, there's so many factors. So, and we've even talked a lot about these. So when you're looking at a mortgage, I guess, if you kind of give us kind of like a list, here's the things that you really need to be thoughtful of, whether it's how much you're putting down, what your rate's going to be, what the house price, like what would those things be that people really need to be considering?
Credit is number one.
Okay.
Yeah. Make sure, like, if you had a bankruptcy or a foreclosure in the past, there's waiting periods. So you got to, make sure you're past those waiting periods. And in the periods, it's different between a FHA loan or a conventional loan. So it's generally, 2-4 years. If your income is going to be based off of alimony or child support, you got to be receiving that for at least 6 months.
Okay.
And so, down payment is not the biggest factor, like we talked about. It could have as little as 1%, but generally a minimum of 3 or to 5%. If you're a first-time home buyer, on a conventional loan is 3%. If you're a repeat buyer, it's 5%.
Okay. Okay. So down payment and then income, would that be?
So income, what type of income it is. If you're getting a bonus and you had a great year, you had a big bonus. Well, I have to take an average of a 2-year bonus, and then your verification of employment's got to come back saying that your likelihood to continue to get bonuses. Otherwise I can't use the bonus. If it's commission type income, I got to take the 2-year average of that. So if you just went from a salary position to a commission, that's like going self-employed. You have to, so you have to be mindful of that. So,
and what if people got raises? So, I made $100,000 last year. This year, early in the year, they're bumping me to 200. Are you looking at last year's tax return and saying, "Hey, you're making 100," or are you looking at what the pay stub is now?
We love W-2 salaried people.
Okay,
because we use that 200,000 right there, and I could actually get, if you changed your job. That's another thing we should talk about. I guess if you're changing positions and looking to buy a house, it's totally fine to move up to another position in the same line of work. And if your income goes from 100,000 to 150,000, I could use your letter of hire showing me that you're going to make 150,000, and I could even close on that loan before you get your first pay stub. I just have to collect the pay stubs after closing for an end investor. But it's kind of crazy because someone could get fired, right?
Yeah.
Yeah.
But,
a lot can happen.
A lot can happen, but for self-employed people, we got to wait 2 years.
Yeah. And what about like part-time workers?
That's a great question.
It's I mean, they can, in theory, work any number of hours each week, but I mean, are you looking at how they've 2 years?
2 years, and then if you're looking to buy a house, saying, I'm going to get a part-time job just so I could afford a bigger house, well, you have to wait 2 years to be on the part-time job.
Okay.
Yeah.
But are you basing that? Are you basing the income based on what they've historically made, like number of hours worked? Or are you saying, we're going to assume you work 25 hours a week, or how?
Yeah, you can't assume. So you have to find out how many hours, and generally I take a 2-year average of the income. If I really need a push, I need more income, I get the employer to send actually how many hours, and then we could times it by their current hourly pay.
Okay.
Yeah.
I mean, these are all, the reason why we ask all this, because, these are very, very common things.
Right.
And particularly, I think with mortgage rates being where they are, people are having to kind of be more creative and more thoughtful about making sure that their credit is clean, that the income is squared away and things like that. You've mentioned a couple times the IDA program. What is that? Like, define it, and how can that help people?
So Illinois Housing Development Authority, you could go to idamortgage.com, and they have all the explanations and all the programs. But they either have a $6,000 down payment assistance that is forgivable over 10 years. They have a program that's forgivable over 5 years, but now they ran out of money. So they run out of money on these programs and they stop them. So when you're out there looking for a house, you could all of a sudden the program not be available. So that's kind of tricky, but
it's kind of like solar credits.
Yeah, right. Yeah. So and then there's one that's it's not payable until your house sells or your refinance, and that's a non-forgivable loan. And then there's a $10,000 0% loan. It's basically a loan that you're paying $84 a month basically on for 10 years.
And this is more for like 132,000 and less type income, or would this apply to more people?
So it wouldn't if you're making over 132. In this county, you have to look at their website for their maximum income limits. It does change what county you're in, but around here it's 132.
Okay.
And it's only Illinois. Wisconsin has a similar program. Other states might have other programs, but
that's probably an important takeaway for, I think, a lot of first-time home buyers who are looking, and they're looking at mortgage rates and they're like, oh shoot, we're out of the market. But there are ways to get into a house, and particularly, as you said earlier, with rent being what it is. Rent just. I was just reading a thing yesterday that Chicago is actually one of the hottest rental markets because there's just so little supply out there. Right. So it might make sense with a program to actually get into a house.
And the interest rate was really a whole lot lower, almost a 1% lower than the current 30-year fix, which,
wow.
but now it's gone up. We're probably about a quarter lower, where generally that program is quarter to 3/8 higher. But again, they don't have the loan level price adjustments to that program. So we have to look at, maybe you don't need that down payment assistance, but the rate is so much better.
Yeah.
They're like, but I don't want to have to owe this money to them. I said, well, look at your interest savings, or park that $6,000 in your bank and just, pay it, know that you're going to pay it back when you sell the house.
I feel like we've talked about so many different things, from first-time home buyers to second homes to all of these. And it's so helpful, but also just highlights how there's so many things you need to be thoughtful of, depending on what type of a borrower you are when you're looking for this. Anything that you kind of, as a final, you feel like, here's what I really want people to remember or know?
Right. Realtor's going to want to have that pre-approval letter, the premier buyer letter, because it's such a hot market right now that no one's going to accept an offer from someone that hasn't talked to the lender, or hasn't had a lender review their income documentation or pull their credit. So that's really important to have that letter before you start looking.
And they get that because they come and talk to you first, which is what you want them to do anyway. That's good. That's a really good point, because there are so many offers that people make, and so sellers are looking through those, trying to choose the one that's actually going to, not fall through.
Right.
So.
And they're looking, who's that letter from too. And so if you're just go online to some online company, I think you might be looked at less of than if you're with a good, reputable local company.
That's a good point. Yeah.
Yeah, because, from a seller's standpoint, if you're trying to get out of a house, the last thing you want to do is you accept an offer based on some not so great pre-approval.
Right.
You're a month into it with all the attorney stuff, and then all of a sudden it's like, oh, we can't get approved for a mortgage, and you've been off the market for a month plus. So that's very important. And getting it from a nice local bank like Wintrust, it's certainly helpful.
Yeah. and it's, you got to go in non-contingent too. The days of going in with, I'll buy your house if my house sells. It's just not happening right now. So it's really important to figure out creative financing so you could afford both homes.
We covered a lot today, and this is really good because I think it should be comforting. I think for people. Again, we all look at mortgage rates and it's like, oh my goodness, they're like astronomical, and it's like, well, if you go back 50, 60 years, this is pretty much at average. So it is something we'll have to get used to. Maybe they come down a little bit, but I think just knowing that there's programs out there, knowing what the borrower needs to do, be really attentive towards credit, your income, things like that. So there are ways to get stuff done even if rates are higher.
Divorce the rent, marry the house, and date the rate.
That makes sense. That's what we're telling people, just like that, where this is temporary, so don't think this is forever. We can always refinance later. So
long term, yield curves are always, like this. So we're in a very unique period of time. So you don't necessarily need the 30-year mortgage rate to go, from 7 to 5. No. Maybe you just need those ARM rates to come down, and then you can refi in a couple of years. Yeah.
I did think of one question, Tom, that I think is actually pretty important for anybody who's getting a loan. One of the pieces is the appraisal on the home that you're buying. And there for a while, it was really tricky to make sure that the appraisal was going to come in high enough that it was worth what you were borrowing. Are you seeing issues with it now because prices are higher? Are appraisals an issue anymore?
That is a great question. Yeah, I'm glad we're talking about it. There are sometimes I don't even need an appraisal. So that, again, if the underwriting program comes back, the Fannie Mae or Freddie Mac might accept the property value and give us a property inspection waiver. But if the property comes in less than your purchase price when you do get appraisal, if you need appraisal, we have to use that lower price in the loan to value. So that means if the seller's not going to renegotiate that price, you're bringing more money to closing. So if you don't have more money, then you're going to lose the house.
Yeah. No, that's helpful. That's why I just remember that was kind of one of the more recent, in the last several years. But
really, I haven't had many appraisal issues. You think you would or the ones I have had, the customer was putting a lot of money down, so it didn't matter. Because you want to make, if you're falling above 80% loan to value, you're going to have to pay mortgage insurance. So but if you're putting if you're putting 50% down and it comes in 10% lower, it really doesn't matter.
All right. No, this has been
this
really
is great.
helpful.
Thank you very much, Tom.
I appreciate you having me in here.
Yes. What's interesting is we'll always call Tom with these questions for our clients. So we're always getting like an update every now and then. So this is really helpful for everybody to hear, really kind of this checkup of what's out there, what's available and new. So thank you for taking time to come in and
you're welcome.
share it with us.
Yeah, thank you for having me.
Yeah, you're welcome. All right, so we've got a lot of resources that we're going to point to in the show notes and on the blog post, so you can check those out, several articles. And then we are going to do a webinar with Tom, so that will give you a chance to ask your questions. That's going to be in November, so we will have a sign up for that. But you can sign up for our bi-weekly email, so you can stay updated on what's happening, what we're talking about in the world of finance. All right, well, thank you so much, and we will see you on our next episode.
Thanks for listening. To find any links or resources related to this episode, check out our show notes. Your host was Michelle Smallenberger, a certified financial planner and CEO. The guests featured are from Financial Design Studio, a team of experienced, fiduciary, fee-only advisors based in Chicago. Anna Lewis is the executive producer of the Behind the Designs podcast. And as always, for more information about Financial Design Studio and who we are, check out our website, financialdesignstudio.com. And final note, no content discussed on this podcast should be taken as financial advice. Financial Design Studio accepts no responsibility for your individual choices. We'll see you in the next episode.